Becton Dickinson, the global medical device company serving hospitals and healthcare systems in over 190 countries with medication delivery systems, surgical devices, and connected care technology.
FY 2025 revenue $21.8 billion. Fiscal Q2 2026 revenue $4.7 billion beat estimates. Adjusted EPS $2.90 beat the $2.78 estimate.
Becton Dickinson was founded in 1897 in New Jersey, manufacturing surgical instruments and syringes for the medical profession. For over a century, it has been at the center of medication delivery infrastructure.
Two transformative acquisitions define the modern BD. CareFusion for $12 billion in 2015, adding medication management, and CR Bard for $24 billion in 2017, adding vascular and surgical devices.
In February 2026, BD completed the spin-off of its Biosciences and Diagnostic Solutions segment, merging it with Waters Corporation. BD is now a pure-play medical device company focused on connected care.
The medical segment generates approximately 70% of revenue. Medication delivery, infusion therapy, pharmaceutical systems, and nurse call systems for hospital inpatient care.
The interventional segment contributes 30%. Surgical devices, urology products, vascular access, and peripheral intervention inherited from the CR Bard acquisition.
FY 2025 revenue $21.8 billion, up 8.2%. BD's connected care strategy links medication management hardware to digital workflow software.
Fiscal Q2 2026, revenue $4.7 billion beat estimates. Adjusted EPS $2.90 beat the $2.78 estimate. FY 2026 adjusted EPS guidance raised to $12.52 to $12.72.
Medtronic competes across surgical and cardiac devices. Broader portfolio, but less focused on medication delivery infrastructure. BD's installed base of infusion pumps in hospital systems creates switching costs.
Baxter International competes in IV solutions and medication delivery, strong in fluids but divesting assets. Stryker and Abbott compete in specific device categories, but not across the full BD breadth.
BD's moat is the medication delivery installed base. Hospitals that run BD infusion pumps, dispensing cabinets, and syringe systems generate recurring consumables revenue that is deeply embedded in clinical workflow.
BD operates across 190-plus countries with manufacturing in the U.S., Europe, and Asia. The U.S. generates approximately 50% of revenue from hospital systems globally.
International markets, Europe, Asia-Pacific, and emerging economies account for the remaining 50%. BD's distribution infrastructure in over 190 countries is a durable competitive advantage.
Tom Poland has served as CEO of Becton Dickinson since January 2020, having joined BD in 2001 and risen through diagnostics and life sciences leadership before becoming president and COO.
Poland holds degrees from Penn State and Villanova. Under his leadership, BD executed the landmark Biosciences spin-off to sharpen focus on medical devices and the connected care platform.
Becton Dickinson, the global medical device company, $21.8 billion in FY 2025 revenue, now a pure-play medtech after spinning off Biosciences and Diagnostics in February 2026, focused on medication delivery and surgical devices.
Fiscal Q2 2026, revenue $4.7 billion beat estimates. Adjusted EPS $2.90 beat the $2.78 estimate. FY 2026 adjusted EPS guidance raised to $12.52 to $12.72. BD's connected care transformation delivering.
Becton Dickinson is one of the most important companies in healthcare that most individual investors never think about. It does not develop blockbuster drugs or novel therapies. It makes the needles, syringes, catheters, diagnostic systems, and medication management software that every hospital in the world depends on every single day. That invisibility is part of what makes it such a durable business, and part of what makes the current moment at BDX so interesting to watch.
Becton Dickinson was founded in 1897 and is headquartered in Franklin Lakes, New Jersey. The company serves hospitals, clinics, laboratories, and research institutions across 190 countries. It operates through three segments: medical, diagnostics, and biosciences. Medical is the largest. It includes vascular access devices, medication management systems, and surgical tools. Diagnostics runs the BD Veritor rapid test platform and microbiology systems. Biosciences focuses on flow cytometry, cell sorting, and research reagents.
Revenue for Q1 2026 came in at $4.7 billion, an 8% increase year over year. The growth was broad-based across all three segments, with medical leading at approximately 9%. The diagnostic segment, which had been declining since COVID testing volumes normalized in 2023, returned to growth for the first time in 6 quarters, a meaningful inflection point that management attributed to non-COVID core diagnostic volume recovery and new point-of-care product launches.
Earnings per share of $2.90 beat the consensus estimate of $2.78 by approximately 4%. The beat was driven primarily by gross margin improvement. The BD Excellence Productivity Program, which targets over $400 million in cumulative savings by 2028, is beginning to deliver measurable results. Research and development spending increased year over year, which signals reinvestment into the product pipeline rather than across-the-board cost-cutting.
The Alaris infusion pump situation is important context for any BDX analysis. The FDA issued a warning letter related to Alaris pump safety software in 2022, and BDX has been in a multi-year remediation process. As of Q1 2026, BDX has cleared a significant portion of the remediation backlog and reinstated limited Alaris shipments in the United States. Full reinstatement is expected in 2026, which would remove a significant headwind on the medical segment's growth rate. Alaris represents several $100 million in annual revenue that has been partially constrained.
Tom Polen is confirmed as Chairman, Chief Executive Officer, and President of Becton Dickinson, a role he has held since January 2020. The earlier flag about a CEO departure was a false alarm. Polen is 6 years into his tenure, which makes him a long-tenured CEO by large-cap medtech standards. His strategic agenda has 3 pillars: the Alaris remediation and commercial relaunch, the BD Excellence Operational Transformation Program, targeting $400 million in annualized savings, and the potential separation of the diagnostic segment. All 3 are mid-execution, which means Polen is managing significant operational complexity simultaneously.
The medication management automation business, dispensing, pharmacy automation, and IV workflow, is a structural growth driver that is frequently underappreciated. Hospitals are under enormous labor cost pressure, and BDX's automated dispensing cabinets, IV compounding robots, and medication barcode systems directly reduce nursing and pharmacy labor requirements while also reducing medication errors. Each major health system that deploys BDX's full medication management stack creates a multi-year recurring revenue relationship that is extremely difficult to displace.
The biosciences segment is where BDX's research moat lives. Flow cytometry, the technology that sorts and analyzes individual cells by their optical properties, is essential for cancer research, immunology, and drug development. BDX has the leading market position in research flow cytometers globally, and the segment generates strong recurring revenue from reagents and consumables. The segment declined in 2023 and 2024 as post-pandemic research funding normalized, but lab spending is recovering and BDX's instrument install base is growing again.
Balance sheet and capital allocation. BDX carries approximately $17 billion in debt, a legacy of its C.R. Bard acquisition in 2017. The company has been deleveraging steadily. Debt to EBITDA has declined from approximately 4 times to approximately 3 times and generates around $3 billion in annual free cash flow. Management has prioritized debt reduction over buybacks, though the dividend remains secure and has grown for 50 consecutive years, placing BDX in the dividend king category.
The international opportunity for BDX is significant but slower moving. Emerging markets, particularly Southeast Asia, India, and Latin America, are investing heavily in healthcare infrastructure as middle classes expand and hospitals modernize. BDX's products, particularly in vascular access and diagnostics, are well positioned to capture this spending. However, pricing pressure in emerging markets and local manufacturing requirements in some jurisdictions limit margin contribution from international growth.
The valuation case for BDX is straightforward, but requires patience. The stock typically trades at 15 to 20 times forward earnings, a premium to the market but a discount to pure-play medical device companies. The Alaris resolution, BD Excellence savings realization, and Biosciences recovery all represent identifiable catalysts that can close the valuation gap to peers. The timing of those catalysts remains uncertain, which is why BDX is a compounding story rather than a near-term event trade. The Alaris infusion pump remediation has been a multi-year drag on Becton Dickinson's medical segment, and the Q1 2026 results suggest that drag is finally approaching an end. Alaris received FDA clearance in 2023 for its updated software, and the commercial relaunch began in earnest through 2024 and 2025. In Q1 2026, Alaris contributed approximately $40 million in incremental revenue versus the prior year period, the first quarter where the product functioned as a growth driver rather than a financial liability. For context, the remediation cost BD approximately $2 billion in regulatory spend, legal reserves, and lost market share over 4 years.
BD Excellence is the company's internal operational transformation program, modeled on the Danaher Business System. The program targets $400 million in annualized cost savings by fiscal year 2027 through lean manufacturing, procurement consolidation, and supply chain rationalization across BD's 3 segments: medical, interventional, and diagnostics. Q1 results showed $60 million in annualized savings achieved, putting BD on track to hit the full-year target of $140 million. The operating margin expansion of 120 basis points year-over-year, from 22.4% to 23.6%, is partially attributable to these program savings flowing through the P&L.
The medication management automation segment is BD's highest growth and highest margin business within the medical segment. Automated dispensing cabinets, which ensure controlled substances are tracked at every touchpoint in a hospital, have an installed base at over 6,000 U.S. hospitals and a replacement cycle of approximately 7 to 9 years. BD is currently in the early phase of the 3rd generation replacement cycle, which includes AI-enabled inventory optimization software that can predict par-level adjustments and reduce drug diversion risk. This software layer is recurring revenue at over 90% gross margin, which is structurally different from the hardware revenue and is expanding BD's overall margin profile.
Tom Polen, who has served as chairman, CEO, and president since January 2020, continues to oversee 3 parallel strategic priorities that will define the BD investment thesis through 2027. The Alaris infusion pump relaunch is generating incremental revenue for the first time. BD Excellence operational savings are flowing through the P&L. And the diagnostics segment separation, if executed, would unlock a meaningful sum of the parts valuation premium. Investors evaluating BD should track progress on all 3 simultaneously, rather than anchoring on any single initiative, since the diagnostic spin timeline is the most uncertain of the 3 and the most consequential for the stock multiple.
The diagnostics segment spin-off at Becton Dickinson is a strategic catalyst that has been discussed for years, but gained concrete momentum in 2025 when BD hired external advisors to evaluate separation structures. The diagnostics segment, which includes the legacy BD Max molecular diagnostic instruments, point-of-care testing products, and the Keystra Lab automation platform, generates approximately $3 billion in annual revenue, with operating margins in the mid-teens. If separated as a standalone company, diagnostics would likely trade at a diagnostics sector multiple of approximately 12 to 14 times EBITDA, while the remaining medtech business, encompassing medical, interventional, and pharmaceutical systems, would command a premium of 16 to 18 times EBITDA on its higher growth, higher margin profile. The sum of the parts valuation uplift from a clean separation is estimated at 12 to 18% versus the current blended multiple, which provides a quantifiable floor for downside scenarios, even if revenue growth slows.
As always on Charged Alpha, everything you have heard is financial education and analysis, not personalized investment advice. Past performance is not a guarantee of future results. Do your own research, know your own risk tolerance, and consult a financial professional before making any investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.